Hey guys, Mike here. So, oh boy, we started off super green in pre-market and overnight, and then all of a sudden, straight down, because really two things happen, not just one. You kind of wake the markets up back into reality, you know. But we're going to go through that. We're going to go over a little more of a big call that was made yesterday and go a little more in detail on why that call was made and stuff. And then a few more things you can look at to see really how close are we to a recession where we really, like everybody feels it, right? Massive layoffs, all that fun stuff. And so what woke the markets up first, we'll just say, was the UK inflation came out, and oh boy, it wasn't good. Their CPI rose to 10.1% in September, and that kind of shook the markets. And I kind of feel like they're in the same boat we're in, right? I feel like they have a bunch of bureaucrats or whatever they're supposed to be over there getting paid that don't know what they're doing, right? I mean, over there, they may even have it worse because, especially economically, because what are they doing? We're going to raise rates. We're going to start selling bonds. We're not going to sell bonds. We're going to start buying bonds to save the pension funds. We're going to do tax cuts. Okay, fine. We won't do tax cuts for the rich. We'll do it for everybody else. Oh, wait a minute. We're just not going to do tax cuts at all. Like, it's just all over the place. And what does that create? What does the market hate more than anything else? Uncertainty, right? Creates more volatility. That's all it does. We've seen it here in the United States when we were going through this with our Fed before they got on the course of just, no, we're going to raise the hell out of rates, right? That's what course they're on now. And the other thing that happened, which won't get any news anyway, because who knows if it'll stay up, but the 10-year, 3-month inverted late last night, early this morning, somewhere in that time frame, and it's predicted every single recession over the last 60 years, that is. And you can see right there, boom, crosses that line. That is the magic line. And as we zoom in, you can obviously see there it goes over it. Now, do I expect it to stay? Not really, but you know, that kind of signals something. We'll see what happens. The deeper the inversion, the worse the recession is supposed to be, but we shall see. And I should say Tesla just reported, and they're down about 6% now. We'll see where it ends up. I know they missed something. But we'll see by the end of this video where we're at, because that was the other thing, the other shoe that had to drop, the only other big company reporting earnings today to keep this market going up, and we'll see how the market reacts to this. And depending on what source you look at, if you count in all recessions, you're looking like 6 to 9 months. If you just go into your deep actual inversions, like, you know, because like 2020, if you throw that one in there, that was technically a recession. Well, the inversion wasn't that long before that, right? If you go into where the stock market just straight crashes, and it's like a 1 to 3 month crash, it really throws the whole thing off. If you look at just like 01, 08, and I believe 1974 or something like that, whatever it was, you look at that, you're looking at like 12 to 13 months, somewhere in that range, really more accurate, I think. But anyway, and if you see what happened on the chart today, you see SPY comes back. That trend line, that moving average, 20-period moving average, and if we go to the 15-minute, what happened? It tested it exactly. It bounced right off of it, retested it, and started heading back up. And so we'll see what happens from there. And something I hadn't updated in a while, and is this right here, is QQQ over SPY, so risk versus value, right? And it actually, 2 weeks ago, busted through this trend line. This trend line has been in place for quite a while, and as it's going down, that lets you know we're risk off. It's going up, it's risk on, which you can see with that big bubble right there. And it's never broke this trend line since it started back in 08. And so that's the first time. And if you look, we scroll forward more, you can see it. I don't care if it's 2020 crash, 2018, didn't matter, it didn't break through. And as we scroll up, look how big that is. Look, an ocean wave, right? That lets you know how much risk we were actually taking on from like 2020, 2021. We've never done it before. I mean, you're talking about just absolute liquidity, boom, being pumped in the system, and everybody buying crypto and everything on the Qs and everything else, right? And so, you know, that's why you see a ton of momentum heading over. So it's going to be interesting to see how that one plays out, obviously. And I mean, right now, yeah, risk off. Why? Because rates and the dollar, right? As long as those are, you know, full steam ahead going up, it is not good for risk assets at all, as you have seen. And we know we still got at least one more rate hike, or two, most likely. We don't know how high they're going to be, but at this point in time, it looks like they're going to be 75 and 50 at least. So that does not help things. And, you know, going into something I put out yesterday, you know, I told you Mike Wilson, who's probably one of the biggest bears this year, but he's been right on the money over at Morgan Stanley. He put out something. This is, I didn't put enough detail into what he was saying when he said they're repositioning because they think there is going to be expecting a year-end rally. And the reason why is, one, because they thought things were going to fall to pieces this year. They thought earnings were going to fall off a cliff. We were going to have the apocalypse. Something catastrophic was going to happen and really just tank the market, right? And layoffs are going to be massive. Well, that has not happened, okay? And so then we started looking at it. Now they're projecting it for 2023, which like everybody else is. And the other thing was this right here. When he talks about the 200 weekly moving average, he says that the stock market never breaks below it and stays below it really hard unless there's a recession. And that's actually somewhat true and not true. If you go from 1974, it is true. If you go back before that, it is not true. As you can see, we have no recession right now. And if you look at 2020, obviously we had the recession, the little green colored or whatever color that is, shaded area. I'm colorblind. So, you'll see right there, 2018, it did not. 2008, obviously, yes, recession, we broke through. Dot-com bubble, we broke through. You go before that, you see, and this is what I'm talking about, there's a recession right there, and we did not break through. It was 1990, excuse me. Did not break through on that recession, did not break through on that recession, broke through on this recession right here in the 70s. And so, yeah, it does happen, but not all the time. And then you see before that, no recession broke through it, no recession broke through it. And so, yes, there has been times in the past where there was no recession, we broke through it, but it was a long time ago, right? And then we've had small recessions where we didn't break through it, okay? You can see that plain as day. And so if the recession ended in 2023 officially, where there would actually be a little shaded area there, then there's a good chance we don't continue down unless something catastrophic happens. There's always that chance. I'm not saying that's what's going to happen, but it also goes back and kind of ties into what I was talking to you guys about when I said the kiss of death happens, and everybody goes, oh my gosh, the kiss of death. Immediately it's all over, the world's over. But what did I tell you about that? You can see, yes, when you get the kiss of death for the long haul, it tends to sell off quite a bit. But look what happens in the short run. We came down, we broke, we moved up. Now I want to go into the daily to show you this run up. It may not be huge, but this is the S&P, and this has to be on the S&P. You can see popped almost 9% in a month right there, which is a pretty good move for the S&P on a regular time frame, right? Look at 2000, the dot-com bubble, 2001 right there. You see, we sold off a little bit more once it was claimed, about another 13%, but then look at the run it took. We'll go to the daily. Look right here. We sold off a little more once the kiss of death had been confirmed right there. I think 15%, but then look at the move back up. We ended up moving up almost 16% in 56 days. So that is a really good move up, which means the stocks were way higher than that. And it's important to note that they're actually calling, which shocked me, for they can see the S&P rallying as much as 4,200 by year end, right? And I think they're trying to really pick it from November into December, like a Christmas type rally, or holiday rally, I should say. And you can see right there, I mean, that will be a massive move. And please hit that like, subscribe button, and share the video if you get anything out of this, guys. I really appreciate it. And it just so happens to coincide with that outer edge of the channel, descending channel it's been in this whole time since January, right? So I'm not saying that's going to happen. I'm just presenting you what they're presenting us with. And when you see, I always say, when you see super bulls turn into bears and super bears turn into bulls, you got to kind of go, okay, and even the other gentleman, I always get his name wrong, but Niles, I think is his last name, but I always get it wrong. He's even saying, yeah, I mean, he can see a short-term rally continuing up into November, but then he doesn't know what's going to happen either, right? Because it's just, as long as that VIX stays above 30, like where it's at right now, we're going to continue to see crazy swings. We just are. And that's why the market would be way better off. I think all of us would be happier if we would just get some capitulation moment, right? I wouldn't care. Let the market drop another 20%, great, and finally get it behind us, because it would unnerve a lot of people, right? They go, ooh, okay, unnerve or nerve, I don't know. But it would make people feel, I think, more relaxed. Like, okay, we went 20% down. We got that capitulation moment everybody's waiting on. The VIX spiked over 45, that kind of stuff. And we might get that because, as you can see, man, liquidity, it ain't good, right? When you're raising rates and stuff like that, like liquidity is key, and you can just see that right now we're down right there. You see October 2022, obviously 2020 we were worse off, in 08 we were still worse. So you can see we still got room to go down, and that can easily happen because obviously the Fed is going to continue to raise rates until something breaks. You see over in the UK right now, things are breaking. That's just the way it is. And And look at the mortgage rates right now. Today, 7.22% on a 30-year fix. I think it was last week I just told you it was 7. It just crossed 7, right? So I said 8 by end of year. There's a chance by November we're over 8 for sure once they do the next rate hike, right? I mean, let me know in the comments what you think it's going to be. But, you know, I'm not buying no freaking home at 8% interest rate. So that's crazy. You know, I'm sure not going to refinance unless I'm just pushing to a corner. I don't know about you. But no, I'm good. You know, I'm feeling okay about that. But it's not good for the housing industry. We know that, right? So the first thing gets hit. And so, you know, the other one I'm going to go into real quick is to show you guys, and I talked about these indicators, right? About whether we're in a recession, how close we to recession, all this stuff. And I mean, where people are getting like mass layoffs are happening, that kind of stuff, when you really feel it in the housing and the car industry, all the big ticket items are just going down the tubes, and everybody's like, oh my God, the world is ending. You know, and if you look at this right here, this is from one of the major firms out there that they put this out. And this was Charles Schwab, excuse me, yeah. And if you look at it, I talked to you about the leading economic index indicator, right? And I talked to you about that. And you can go through the level we're at and what the trend is, right? And so you see average work week is weak and it's worsening, which means people are getting less hours, that way don't get benefits. Unemployment claims still strong and stable. That's the big thing. New orders, consumer goods and materials are fair and stable, which, you know, surprising, but they are. ISM new orders index weak and worsening. New orders non-defense capital goods, aircraft and stuff, fair and stable, because, you know, government's always buying. Building permits weak and worsening. That makes sense because obviously the real estate industry is weakening. S&P 500 is weak and worsening. We know that one. Leading credit index fair and stable right now. It's just because we have a whole lot of money on the sidelines, and, you know, people are blowing up the credit cards, all that good stuff. But, you know, that's where we're at right now. And plus companies, and I don't think it's even in that one, but companies hadn't had to actually refinance their debt yet. That's going to be an interesting time frame. Interesting rate spread we know is weak and worse, and I just showed you one of them. And I just did a whole video on that for the members. So, I mean, they got to see it. Average consumer expectations for business conditions. Let me not even look. What's it say? Weak and worsening. Yes, I am shocked on that. Can you believe it? You know, and then, of course, there's the coincidence one, which I talked about. This is the one I really track. This is the one that turns down when you really fast when you go into the real recession. You won't know you're in it. There it is. But look at this. Payrolls, personal income, industrial production, real manufacturing. Payrolls, personal income, real manufacturing are actually strong and stable. And then personal income, less transfers and payments are improving, right? And I'll touch on that more in just a minute. But, you know, I think the line of this that sums it up for me is when they start talking about, perhaps more important today is to recognize that several segments of the economy are experiencing their own recession. These are those rolling recessions I mentioned the other day, including housing and segments of the goods side of the economy, with services a positive offset for now. Asset owners are feeling sharp pain from the everything bear market, while most consumer spending power has dwindled under persistent hot inflation. And so, of course, why is personal income and all that stuff strong? Because people are still getting raises. People still have jobs. People still have savings. People are still sitting on tons of equity in their homes. All this stuff, right? People still have room in those credit cards to run them up more, right? We haven't seen the defaults rise crazy or anything like that. And 70% of our economy is services, right? Not products. Services tend to be cheaper. And so we're still spending. We're still doing that part of it. As far as buying houses, cars, boats, you know, jet skis, whatever else you can buy, RVs, that's big ticket items. And usually you finance those. So that means you're paying with those high interest rates. People tend to shy away from that in these kind of times, right? And so, and then when you hit a real recession, those really fall off a cliff. And so, but that's, you know, at least you get a snapshot of where we're at, because remember, it's extremely important to understand, and I keep updating you guys on this, where we're at in the business cycle, which, i.e. the economic cycle, and where we're at in the stock market cycle, because the stock market will bottom and turn up before any of the rest of it does. And that's what I'm telling you. There's that moment, and you'll see it, you've seen it multiple times this year, where the stock market detaches itself from the economy in the real world and does what it wants to do. But anyway, I'm going to get off my soapbox, and so that's where we're at, guys. We'll see what happens tomorrow. Obviously, we'll see where Tesla ends up. We'll see if this market, which I still feel like just wants to have this short-term rally, because, I mean, it's not crashing and burning right now, but we got the big boys report next week, so it'll be a big one to report on. Let me see where Tesla's at right now before I get off here. Let's see, in Tesla, only down 2.83%. So there you go. You know, even with missing certain things, don't matter. So anyway, hope you guys got some out of it. Hit the like, subscribe button if you did, and I'll see you tomorrow.